Hello students, welcome to another video from QuickStudy, and this video covers the importance of cash flow to our business from topic 1.3, putting a business idea into practice. So without any further ado, let's get started. In this video, we'll talk about the importance of cash flow to a business, which involves paying your suppliers, paying for your overheads, or paying employee salaries. We'll also learn about how you can use cash flow to your advantage to prevent business failure or insolvency. And we'll also talk a bit about the difference between cash and profit. So firstly, let's talk about why cash is important to our business. And as we all know, cash is the one thing that we always want more of. And it's the same for individuals and businesses, right? So a business needs cash to pay for their bills. They might need cash to avoid legal actions or even prevent business failure. A business has to pay their employees on time, right? So that they show up all motivated and empowered to work to the best of their abilities. And at the same time, managing cash can be difficult. You see, as an individual, we struggle to manage cash effectively, and it's much harder for businesses to do the same since there are multiple stakeholders that a business has to deal with, starting from the owners to shareholders, managers and employees, and the government, and so on. So there are critical issues that a business faces when managing cash flow. First of all, for startups, it's different because a startup, there are significant expenses when you're starting a business since you do not really have enough cash coming in and there are lots of places that you have to spend cash on. So how do you really manage that? Say, for example, if you are starting a restaurant business, first of all, you need to hire staff, get the place where you're going to set up the restaurant, buy equipment, buy assets, and invest in all those. And remember, you haven't really made any sales in that time period. And there might be other delays along the way to get the restaurant all up and ready and working. By the time you start to make sales, it's probably going to be a bit late. So it's going to be a while before the cash starts coming in. But by that time, you've already spent a lot of money. So for startups, you'd have to wait quite some time before you start to actually make money. Then there is a different phase, such as a rapid growth phase for a business. When a business is facing rapid growth, they have to spend a lot of time or money and valuable resources in marketing and advertising, which can really drain up your resources quite fast. And that is because there is a higher operational demand. You see, you might need to hire twice the amount of staff that you have right now, and you'd have to accommodate more people. You probably want to open a new branch, or you want to expand the current premises that you have for your restaurant, and that involves spending a lot of money as well. But the demand might not follow through in the same way. You might not have as much demand, right? So you really need to spend some time to burn the cash and wait till you have enough customers or have enough cash coming in before you can turn that loss into a profit. Alright, so to understand the importance of cash to a business, let's define what cash really is. So cash is basically both the physical cash that you have as well as the amount that you have in your business bank account. And why is it really important? First of all, there are suppliers that you deal with to purchase goods or services from. Now, here's the thing. A supplier will provide you with a credit period. Say, for example, 60 days. You can buy the goods from them and then take at least 60 days to pay off. And this time period is usually interest-free. And this is built off of the kind of relationship that you have with your suppliers. The better the relationship that you have with them, the better credit terms that you're gonna get. However, it's important that you maintain a good relationship with them in the first place. If you are late on making payments to your suppliers, you can't really expect them to provide you with the same credit facilities later on. And that might lead to you having empty shelves or not being able to provide the service that you want to make the sale that you need. And of course, you'd also have to pay salaries to your employees on time. That's the least or the most basic thing that an employee would expect from working in a particular company, to get paid within due time. And failure to do that would lead to demotivated employees and who are not really empowered, who won't put in as much effort as you would like them to. And to give you an example, during the 2015 or 2016 session, the Bolton Wanderers Football Club were not able to pay their players' salaries on time. and this led to a lot of the top players leaving the club. And that is the worst possible position you could put yourself in. You see, when the top players of a club leaves the club, or the best employees in an organization leaves, there is a risk that they might join your rivals or the competitors, and that would put you in a position that is disadvantageous. All right, so since we've already talked about the main day-to-day expenses that your business has to make, which includes the salaries that you pay to your employees or the payments that you make to your suppliers, you'd also have to consider that it's important that you make the payments for the overheads on time as well, which includes the rent for the premises or the utilities. Just because you're having a bad month does not mean that you can skip out on paying for these expenses, because this will likely cause disruptions in your business processes, and it's a lot like the lights going out. It does not really help you any further. And you also need to understand that the impact of cash flow on businesses is not really the same. Tesco sells a lot of products to million different customers. For whatever reason, if they lost out on a few hundred or even 1,000 sales, it wouldn't impact them as much in comparison to your local grocer who had limited customers to begin with. If they lost even on 100 sales, it would severely impact their cash flows, right? So first of all, you need to understand how should cash be managed best. First of all, you need to do a cash flow forecast. What it essentially means is that you will make a prediction about the cash inflows and the cash outflows from your business. And what it can help you do is identify time periods when you'd have a shortage of cash or when you'd have an excess of cash. So there are a few strategies that you can use to best manage your cash flows. First of all, you can negotiate a generous overdraft facility. And having an overdraft facility where interest payments are low and you have a longer time period to pay off the balance, it can help you make payments which will allow you to sustain business operations without any disruptions. If I were to give you an example, say for example you have a shortage of cash, and if you take out an overdraft for that particular amount for a short period of time, maybe 3 to 4 days, you won't really have to pay a lot of money in interest charges. And you can also pay for that expense in due time as well. So another strategy to improve your cash flow or manage your cash flow includes controlling your costs better. So what it helps you do is basically ensure profitability, at the same time reduce your costs and increase your revenues. You see, when you are controlling your costs better, it would mean that you'd have to cut back on unnecessary expenses. You might not be able to go out with your employees for different kinds of fun stuff that you would want to do, or you might not be able to renew the fleet of cars that you have at your company. And another strategy to maintain your cash flow is to maintain steady cash flow along the way. You see, not all of your customers were created equal, because not everyone will pay you on time, and you should not be lenient with every customer with your credit terms, because if you cannot get the payment from your customers in due time, you won't be able to make payments to your suppliers in due time as well, and that would cause disruptions in your business operations. And long-term payments will also cause other issues, such as increased chances of bad debts as well. So you need to be careful of these credit facilities, because most of the businesses around the world and in UK as well operate on credit. And you should be able to identify the difference between cash and profit. And to give you an example, it's much easier for you to understand. Say, for example, you work at your aunt's clothing store for a day, and she has asked you to calculate the total amount of cash there is in the register. So what are you going to do? You're going to go to the cash register and then add up all the cash there is in the register, right? And leave out the float, which is probably for the day-to-day running operations of the business. So when you add up all the cash, that's not really the total sales for the day, because there are customers who have paid using their credit cards or their debit cards, which will be later added along with the cash balances. That's when you get the total revenue. And this is how you know that the total revenue and the total cash is different. So cash flow has more of an immediate impact on the business after the transaction. However, when we talk about profits, there are other factors to consider as well. because profits are only calculated after you have deducted the expenses from the revenue, right? And the difference is quite substantial between how much revenue you have generated and how much cash you have had, provided that there are card payments, right? So this is how the cash balance and the profit balance, as well as the revenue balances, will often differ, and they're not really the same. So from whatever we have discussed so far, you understand that cash flow is actually the lifeblood of a business, and proper planning is critical to make sure that you have enough cash when you need it the most. And since we have already talked about a few strategies that you can use to manage your cash flows better, I'd also like to add a bit to it and say that you should always prepare for the unexpected. You see, if you have secured a large overdraft account or a facility that allows you to draw cash when you need it, it can alleviate a lot of the financial pressures that you may face along the way. And of course, you'd also have to make sure that the interest charges on that overdraft account is at the minimal. And students, with that, we have come towards the end of this video. And to give you a short recap of what we have covered in this video, we have talked about the importance of cash to a business, which is to pay suppliers, make payments for your overheads, and to your employees. And we've also talked about how you can use cash flow or manage cash flow better to prevent business failure. We have also talked about the difference between cash and profit. So students, I'd like to thank you for watching this video, and if you've liked this video, do subscribe to our channel since we post regularly on different subjects and topics that can help you ace your GCSEs. And if you'd like to know more about our one-on-one online tutoring services, do visit our website at www.quickstudy.uk. Thank you.